The surge in fuel prices to record levels due to the Middle East conflict has exposed the vulnerability of the Philippines to global energy shocks. Before the recent rollbacks, the price of diesel surged to as much as 160 pesos per liter, gasoline over 100 pesos per liter, and kerosene to also beyond 160 pesos per liter. The high fuel prices were caused by global oil prices surging to almost $120 per barrel, triggered by the Middle East conflict. Apparently, the Philippines imports more than 90% of its oil requirements from the Middle East. Fortunately, electricity rates did not surge, as the country relies more on coal for over 60% of power generation, while renewable energy accounts for at least 30%. The share of natural gas in the country's power generation is also increasing, especially with the discovery of new reserves at Malampaya. Hence, the Middle East conflict revealed the country's public transport system being too reliant on fuel, as it is made up mostly of vehicles that need diesel or gasoline to move commuters. On the other hand, current mass transport systems like the MRT-3 have to operate at peak capacity, while the other rail systems like the Metro Manila subway project will likely be completed in 2028. Furthermore, the country's logistics system also depends on fuel to move products, including agricultural produce. Hence, high fuel costs can increase food prices. A lot of lessons can be learned from the countries that were able to absorb the fuel price shocks from the Middle East war. And we look at the cases of China and Indonesia. According to data published in the website of the U.S. Energy Information Agency, China had the largest strategic oil reserves globally as of December 2025. China had reserves of almost 1.4 billion barrels of oil as of December 2025, which is more than 3 times the United States. China also has diversified sources of oil imports. This graphic from the website of the Center for Global Energy Policy at Columbia shows that China never relies for up to 20% on a single oil supplier. The graphic shows that China's oil sources include those outside the Middle East, including Russia, Canada, Angola, Brazil, and Malaysia. The lessons from China are very clear. Number 1. It is best to have large volumes of strategic oil reserves. Number 2. It is best to have more than one source of oil supplies. It is also worth noting that China has large oil refiners and exploration firms, such as China National Petroleum Corporation, China Petroleum Chemical Corporation or Sinopec, and China National Offshore Oil Corporation or CNOOC. China's petroleum firms have a vast international presence, enabling them to source crude oil and natural gas from other countries. Example, Sinopec has projects in 23 countries. China National Petroleum Corporation, Sinopec, and CNOOC are majority owned by the Chinese government. Sinopec operates 30,000 retail stations, giving the Chinese government leverage in stabilizing fuel prices. And from China's state-owned oil firms, we get lesson number 3. State-owned oil firms are among the best leverage to stabilize fuel prices. As of late April, the price of diesel in China was lower compared to the Philippines, equivalent to $1.19 per liter, or 71.40 pesos per liter. As for Indonesia, the state-owned oil firm Pertamina helps stabilize fuel prices through subsidized products. For example, Pertamina's biosolar subsidized diesel retails for 6,800 rupiah or 40 cents, equivalent to just 24 pesos per liter, as of late April. On the other hand, Pertamina's non-subsidized diesel, marketed as DEX, retails at 23,900 rupiah per liter or $1.38, equivalent to 82.8 pesos per liter, which is still below Philippine diesel prices. Pertamina is also one good example of a well-governed government corporation. As of 2024, Pertamina recorded revenues of $75.5 billion and profits of $3.13 billion. And while Indonesia has its own oil production fields and oil reserves, it imports oil and fuel from various countries, particularly Singapore, Malaysia, Saudi Arabia, Nigeria, and the United States. Here are the 2 lessons from Indonesia. Number 1. Having a state-owned oil firm that is also the largest in the country can help stabilize fuel prices. Number 2. Like China, Indonesia also has diversified sources for its crude oil and fuel requirements. Looking at the ecosystems of China and Indonesia for oil and fuel, it is very clear that the Philippines failed in 2 areas. Number 1. Failure to diversify sources of oil, as the Philippines relied heavily on the Middle East. Number 2. The government had no leverage to control the rise in fuel prices, of which Indonesia had through the state-owned Pertamina that is also the biggest petroleum firm in that country. Sinopec operating about 30,000 fuel stations in China also gives the government leverage to stabilize domestic fuel prices. To recall, Petron Corporation was once owned by the government, and was created also to help stabilize fuel prices in the Philippines. It was Claro M. Recto who put forward the idea of a state-owned oil firm to help advance Philippine industrialization. Meanwhile, the minimum that the Philippine government could have done to reduce fuel prices is to suspend the excise tax on petroleum products. However, the palace did not approve of this measure, even if Congress passed a bill for the matter. The Downstream Oil Industry Deregulation Act is also being blamed for the almost uncontrolled increase in fuel prices in the Philippines right after the Middle East war started. That law sets the pricing of domestic fuel products based on global market forces. Also, after the signing of that law in 1998, there was no major investment made by any local or foreign investor to establish another oil refining facility in the Philippines. Today, Petron remains the only oil refiner in the Philippines. So, is the Downstream Oil Industry Deregulation Act of 1998 useless?